Hello, everyone. Thank you so much for joining us for our first webinar of 2025. I'm your host today. My name is Jeremy Kronemeyer. I'm Operations Manager for Wickham Financial Group. And your presenter today will be Graham Wickham, President and CEO of Wickham Financial and Insurance Services. A little housekeeping here at the beginning here. So Graham will speak for about 20 to 25 minutes on the call. And then at the end, we'll have about 5 minutes for some Q&A. If you do have questions during the call, in your chat box, there's a Q&A section where you can put your questions there and I'll be able to see them. And if there's not too many, we should be able to get to them all at the end of the call. And also today for our agenda, Graham will be doing a year-end review of 2024 with some index returns and some themes of 2024. But what's next ahead for 2025, and then some themes for 2025, and then some general considerations as well. Graham, take it away.
Yeah, thank you, Jeremy, and thanks for everyone jumping on the call. And the ones who weren't able to make it on the call, don't worry, we're going to send it out to you so you can get an idea of what Jeremy just mentioned, kind of that wrap up for 24, and then our thoughts, consideration. We're calling them themes. Just going to be, talking points of what we think might play a role in how the markets, the economy, all this great stuff might shift out for 25. But let's go ahead and jump in. So let's just kind of wrap up 24 with some numbers. So if we look at gross domestic product, 24 ended up closing out at a growth of the gross domestic product of the United States of about 2.77%. CPI, that's Consumer Price Index, that's inflation. So when we're talking about this number, we're not talking about the core number, stripping out food and energy. The CPI is what they call the headline number. And that was about 2.9%. Now, keep in mind, and I'm going back a couple of years here, but in 2022, the height of the pandemic, height of inflation here, maybe not the pandemic, but the height of inflation, we were just over 9%. So we've made huge strides down. But, and we'll talk about this later, there still are some areas that are pretty sticky, stubborn, if you might, in terms of making that next step down. But again, that'll be a part of the conversation in just a bit. So let's look at the Standard & Poor's 500. That's probably the index that I would really encourage most to follow. That's 11 different sectors of the U.S. economy. It's 500 stocks, small, mid, mostly large. Keep in mind that about 30-odd, maybe up to 40% is tech. In that general area. And because it is and I'm going to go over this again and again, a cap-weighted index. And you might be asking, what do I mean by that? So cap-weighted index means the largest companies that make up that 500 stock index hold a larger weighting in that index. So if you think about that MAG 7, maybe expand it out to 10, they make up about 30% of the index. So that leaves another 493 for the 7 or 490 out there playing some role in terms of the S&P's performance. The reason why that's important because it's very concentrated, or we've been very concentrated, those 7, 10 names, maybe 3 core sectors for 23, off and on in 24. We'll see, and we'll talk about what that might look like for 25. Now, we look at the Dow Jones, that was up about 15%. Keep in mind, that is a price-weighted index, not a cap-weighted like the S&P, but a price-weighted. 30 stocks, not super broad, not a great predictor of what's going on overall. Not that's not doesn't have its value. I think the S&P's just takes a broader picture of that. And keep in mind, it's price weighted. So for example, today, if you've looked at the market, we got United Healthcare down. I think that's causing somewhere in terms of, I don't know exactly where it's trading right now, but at one point, 150 points or 100 points of the Dow pulling back because it's a large price in that index, holds a larger weighting. Hope that hits home with everyone. Always here to explain that further off this call. Then we got mid-cap 400. That was up about 14%. The Russell 2000, that small cap area, up about 11.5%. We look at the NASDAQ. The NASDAQ's that area of large technology focus, those AIs, the cloud, the chip area, all this stuff that's been the big rally of last year outside of crypto. That's what's held inside of this NASDAQ area. And that was up about 30.77%. And keep in mind, when we're looking at the indices, what we're doing is we're also adding in there as a part of the percentage total return, whatever income or dividends that pay out, that index pays out. We're just reinvesting that. We're showing it as a reinvestment, not that you took it. Okay. Look at equal weight. So going back to how the structure of the S&P is made up, because it's a price-weighted, cap-weighted index. So the equal weight is saying, listen, let's take the whole S&P 500, and let's say every one of those names in there has an equal weight. Then how did that index do? Look at the difference there, about half, right, of the S&P index, 13% return. So we've had a very big focus in a small amount of area, leading to some big outperformance for the cap-weighted index over the equal weight. Then let's wrap it up. Let's just throw some bonds out there. The 10-year seems to be what everyone wants to follow or talks about the most. So that's why we put it up there. Listen, this thing could be 100 slides just on how indexes return and whatnot. But if we look at the 10-year Treasury, it closed out somewhere about 4.58%. Keep in mind, we had a roller coaster all year. At one point, I think we're over 5%. We went down to about 3.5%, and then we ended the year about a point higher on the 10-year Treasury. Now, that's a lot of volatility, leading to why we see bonds performing, underperforming, small caps underperforming, outperforming. Again, we'll get into that in much more detail here in a bit. But let's follow this a little bit further and look at the top performing sectors. So pretty, I guess, all over the place. And it also depended on the part of the year that we were in. There was really a part of the year that we didn't see the more value-oriented area really show up, where we saw, the more concentrated side of the market, that Mag 7, 10, maybe the top three sectors here really start to outperform. So that was communication services up about 40%, information technologies like NVIDIA's or Apple's, for example, that side of the market or that sector was up about 37. Consumer discretionary about 30, just under 30%, and financials had a great year of about almost 29, and a great year actually for utilities. As we went into 2024, there was a lot of speculation that, hey, the Federal Reserve, Federal Open Market Committee, is maybe going to do 6 different cuts to lower interest rates. So anything that's interest rate sensitive, bonds, utility, real estate, or real estate investment trusts that would be traded on the stock exchanges, they had some pretty good outperformances at one point, and then reversed when we realized that the Fed wasn't going to lower 6 times. They ended up only lowering 3 times, 50 basis points at one meeting, 25 and 25 equaling 1. So let's get into industrials, up about 16%, consumer staples. Think about it as that your everyday products, good or bad, economy, good or bad, you're still going to use staple products. Real estate closed out the year only up 2%, energy about 2%, healthcare 1%, and then materials was the only sector that was down at just over 1% for the year. So what were the themes of 2024? And I know we probably don't put everything of interest in 2004. We're just trying to hit on the things that we see our clients asking the most about, or what's in the news. But geopolitical events, without hesitation here, that's huge. Unfortunate that we're seeing the things going on in the Middle East all the way to Ukraine. The election was huge. The market was a bit on hold, wondering, who is going to be elected, and how could that turn out? So the new administration was huge. We saw about a 6% pop after Trump was elected in the market. Now, the market ended up giving up most of that, if not all, but pretty much most of that, as we ended the year out with a bit more volatility than just a straight up run that we usually see in that Santa Claus rally. Keep in mind, a Santa Claus rally is the 5 last trading days of the year and the first 2. That's what they call a Santa Claus rally. Now we look at the Fed started lowering interest rates. Remember what I said? They ended up lowering about 1%, but the market was expecting a lot more at the beginning of the year. I'm not saying we were expecting that, but the market was expecting that. Definitely too ambitious. And like I've said before, if you've listened to our weekly wrap-ups, if you're a client, we've talked to you many times, be careful how much you want the Fed to be lowering interest rates. If they're aggressively lowering interest rates, it's for a reason. It's not because the economy is great. It's because they're concerned. And if they're concerned, we could be talking about recessions. But we're not going to be talking about recessions today because we don't see them. They're not in the cards. It doesn't mean you couldn't have an event to kind of push us into something, but we just don't see that. So there's no reason for the Fed to be as aggressive. So the market had to go through some volatility and readjustment when it didn't get really what it wants. And really the dominance of the Mag 7 off and on. We did see a bit of a broadening out last year, but then it kind of stalled out when we figured out the Fed wasn't going to lower as much. And then they said maybe 2025, they're not going to be lowering as much. Maybe instead of their anticipation of 4 rate drops in 2005, maybe they only do 2. Maybe they do 1. Maybe they don't do any. Hopefully they won't raise. That's not necessarily what we want. I'm not necessarily expecting that. But so that broadening out kind of paused, right? That underperformance of value compared to the growth, compared to those tech themes, started out strong and then it petered out. Bonds really started out really having a great year. And then when those yields popped up on that 10-year across the board, if you might, that really what that does when yields move up, that pushes bond values and pricing down. Doesn't mean you don't get paid a lot more, and you are. A lot more than what we saw pre-pandemic, so on and so forth. But the value or the appreciation of bonds came down as interest rates moved up and the Fed kind of backed off on being aggressive, or the anticipation that they're going to be aggressive on lowering rates. So if we look at 2025, what's the overall theme? But before we start, let's be real transparent here. Listen, we're in a solid economy. 2.7% gross domestic product is nothing to sneeze at. That's great for such a large established economy that we're in. We're looking at solid earnings growth. We have it last year. We're expecting good earnings growth this year, and we have a good consumer, right? Listen, we got the unemployment rate down to about 4.1%, just republished from 4.2%. That's great. If you got a job, you're feeling good, you're probably going to spend, and that's exactly what's happening. That adds to profits and revenues, hits the corporate companies' bottom lines, and what happens? Stocks follow profits. So it's not unreasonable to assume why the market did so well. Reasonably good earnings, solid economy, solid consumer. Now, the question mark would be, do any of these falter, right? So if we lose out on earnings, we lose the consumer. Now we got some question marks about how solid this economy may be in 2025. That's why I put up there cautiously optimistic. I'm optimistic because I expect those bottom 3 things I keep talking about to hold up. But if the earnings or consumer falters, employment picks up or unemployment picks up, that could affect that. Cautiously optimistic. So a new administration, listen, we just don't know. I love the intro slide that we had to the whole thing. I mean, there's signs pointing in all different directions. We don't know exactly. Now, we know there's a lot of bark, maybe not always a big bite compared to the first 4 years for Trump. We'll see if that holds up. Doesn't mean that these things don't need to be addressed, but to the validity of the aggressiveness on tariffs, when they were talking about 60% tariffs, we're going to be talking about the Smoot-Hawley Act almost, 100 years ago, when I think we went into a depression at that particular time, and we saw huge corrections in the markets. Not expecting that, but it doesn't mean we won't get volatility around maybe tougher tariffs that maybe need to happen. What about immigration? How aggressive are they going to get about immigration? Do we need to be more mindful of who's coming in and what they're paying? Oh, absolutely. If nothing else, that's just security that we need to be mindful of. But a dramatic deportation, that's going to raise the cost for payrolls, for workers. That's inflationary. Don't be expecting in that particular situation that the Fed's going to be super aggressive about lowering interest rates, because some of these things I'm talking about are pro-growth. Now, they may be negative to the market for a short period of time. Maybe the long term, it's good for the market. But the aggressive stance that we're hearing, and we don't know any more than what we've heard, so we got to go off that a little bit. I think all this is going to be tempered down a little bit, but that could be very inflationary. Government debt. I mean, I don't think there's anyone out there that says, hey, listen, we got to stop the spending without justification. There is no justification for all this spending. So yeah, I think the new administration is looking to reel that in. But listen, at the same time, if you're going to bring in debt and you want to lower taxation or continue those lower taxes, which is fantastic, we still have to have revenue growth. We don't have a spending problem in the United States. Excuse me, we don't have a revenue growth earning problem in the United States. We have a spending problem. Again, not my platform, just a fact on that. Deregulation, I think that could be really positive for the market. So some of these could over-aggressive approach towards immigration tariffs or not addressing spending and debt could be a real big negative, but addressing that debt and possibly addressing to the first two could be very positive. But deregulation, that could increase mergers and acquisitions. That's profits and revenues for the companies and the financial institutions that facilitate that, hitting the bottom line. And we know what happens when profits and revenues go up, generally stocks do, right? So let's get down to inflation and the Fed, higher for longer. I think we got to expect it. If we're thinking about a strong economy, reasonably good earnings, and a consumer, and some of these things with the new administration being pro-growth, then how aggressive does the Fed need to be? Probably not super aggressive, right? They need some ammunition, if you might, to address a real slowdown in the economy where they could get more aggressive on lowering rates. So that's why let's just temper our enthusiasm with rates coming down so much. Not that we don't want mortgage rates to come down for new home buyers coming in and make it more affordable for the lower middle class. Absolutely. But I think it's all needs to be done within measure. Valuations, we get this all the time. Well, listen, the market's at high valuations. It's got to pull back. Not necessarily. The 90-year average valuation for the S&P is averaging around 17.9%. We're currently around 22, give or take, who you're talking to and what day in the market. Yeah, that's not cheap. The market is not inexpensive. There's certain sectors that are extremely, frothy, if you might, overvalued, that animal spirits are there. There's some sides of the value market. We looked at the bottom 3-4 sectors that underperformed last year. Do we think they're overpriced? I don't think so. When we're looking at healthcare, we could be looking at industrials that might have earnings growth in the 19% range or high 15s. That's really good growth, but they haven't got a lot of performance compared to that tech area. Right. So then we think, what is the story next year outside of the top three? If this wasn't enough, we think maybe the market broadens out a little bit. It's reasonable and responsible inside your portfolios, not to mention just the market in general does this. They say, hey, listen, what were the outperformance? Those top 3, 4, or 5 that we talked about, those sectors last year, maybe people take some profits and they start moving money over to the underperforming sectors, right? But again, earnings have to be there to justify it for sustained rallies throughout a year. But it's reasonable to expect, even though what has done well, as long as the earnings are there, should continue to do well, maybe just not as well. All right. So let me jump through here. I'm getting a little long-winded, but I want to jump in and talk about the presidential cycles. Listen, everyone always, what happens, there's not a guarantee of any of this, but going back from 1928 to about 2023, we generally see some positive returns in the S&P index. Maybe some enthusiasm for the new administration coming down and some policies they might pass that might be pro-growth. If we look at inflation, and this is where we're talking about valuation, we've been consistently over time seeing, and we've gone back a pretty good amount of time here in this chart, we've been seeing some higher growth. We've been seeing some higher inflation. We've been seeing some higher multiples in the market. Why? We'll get into something that I think is causing that, and that's increased productivity. And a bit of it could be we're just being more efficient and being more efficient per job and a profit per job. That's now dropping to the bottom line of corporate balance sheets. And helping out justifying higher stock prices. The Fed's policy, listen, what happens to the markets 1 year, 5 years later? The trend, it doesn't matter if it's bonds or U.S. stocks or a blended 60-40 portfolio. And we've shown this slide before. The markets are up. You're going to get volatility, 5, 10%. Hopefully we don't get 20%, but you got to expect that, especially when we've had 2 really good years generally in the S&P index, 2 really good years with the S&P index. Now, what happens when they start cutting, right? And we're looking across asset classes from cash to bonds, international, US. We've seen some in non-recessionary environments compared to recessionary environments. How can each of these sectors perform? So if we think we're going into a recession, bonds and cash outperform. Not. We think what you usually see is international stocks and US stocks, stocks in general outperform in a non-recessionary environment. And here, what we're looking at is market valuations, right? This is what I was talking about before. Listen, what we're seeing, we're so much more productive, which each job, each employee being a part of that job, we're being more efficient. Why? Because of technology. Why do we have a higher valuation in the United States? We're trading at 22 times forward earnings on the S&P. But if you look international, the international market on average might be 13, 15 times forward earnings. It's because our largest industries grow quicker, faster, and they carry a higher multiple because of that growth in earnings. That's technology. International markets aren't as heavy as we are. So that's why we can justify, and that's what we're illustrating here. That's why we can justify some higher valuations. But we need that earning growth. The market's kind of predicting, and I've seen different numbers, 12 to 15% growth. We're going to need that type of growth to really justify. If we don't get that type of growth, we're going to see a bit more volatility in this market. So let's wrap up some things with some considerations for 2025, and then we'll get into some questions and answers. Diversification. I think that's without hesitation, right? Concentration builds wealth, diversify keeps it, right? But we want to diversify, but I don't want you to diversify out of having returns, right? So we still want to lean into maybe stocks over bonds, right? Now, listen, I'm all for diversification. I think the U.S. is going to outperform international, definitely if we get aggressive with those tariff talks. Also, the growth, the valuation, the tech sectors, that's big here in the United States. That causes us to have a bit more growth, a good bit more outperformance in the United States compared to internationally. But having a good diversified portfolio protects you from that volatility and provides some peace of mind, right? Alternative investments. What would I be talking about there? In vogue over the last couple of years, private equity, getting outside of the publicly traded markets and looking at things like the senior loan market or the real estate market, or different things that are held off the public exchanges where you may get a little bit higher returns than what you could get in the public market. At the same time, you might have to give up some liquidity. But that could be something that you explore with us or whoever you currently work with. Underperformers may be the next outperformers. Now, I say that with some question. I don't know. There's no crystal ball. But logic would assume if these are the biggest underperforming areas, maybe they have a chance to maybe catch up a bit. I think the Mag 7, I think the 10 or whatever you want to label them, technology, that's without question. That's the future. AI, chips, clouds, all that great stuff that's been driving this market. That's been the focus. But it might be harder because the law of large numbers is challenging, right? For these multi-trillion-dollar companies now, right? Doesn't mean they might not do well, but maybe they don't do as well as some of the catch-up trades, like the value side, right? What do I mean by value? Underperforming, underappreciated, maybe higher dividend areas, maybe a little more boring areas, maybe like healthcare or real estate, utilities, things like that. What about small caps and mid caps? Multiples on those and their performance was what, 15, 14 compared to 22%, 25% for the S&P or 30% for the NASDAQ. I think there's some catch-up trade there. Fixed income. Well, we're going to need some help with interest rates coming down to give capital appreciation. But keep in mind, you get paid really well in many of these fixed income areas. And then international. That's one's a struggle, all right? Doesn't mean you don't have performance there, but it hasn't been keeping up with the United States. Because remember, we're talking equities. You could always look at fixed income internationally too, which has a little bit higher yields that we're seeing on average than the fixed income area in the United States in some areas. But let's dive into this with the last couple slides. You know we love slides here. Here we're talking about the disconnect, maybe not completely irrational because I think it is justified. So you're seeing the equal weight S&P 500 compared to the weighted 500, the one that most of us follow. We're looking over a period of time. It's about a 50% underperformance. So I think there's some room to catch up there. Usually these areas don't divert from themselves or the comparables for an extended period of time. There is a period where they start to come back together, and I wouldn't be surprised to see that. Here we're talking about how small caps has really underperformed international large, U.S. large. So maybe there's a catch-up trade there. If interest rates come down, that helps with small caps. If they got debt on the books, less debt they got to pay, not affecting their profits and revenues as much, at least our profits, higher profits, maybe higher prices is where we're going out with that. And the last but not least, we're going to be talking about municipal bonds. Now we're targeting an area. You got to see what's right for you, but we're talking about you getting paid and what the potential income could be. So just income from the S&P. We're not talking about a capital appreciation here. That's 1.3. Aggregate bonds paying at about 4.6. Municipal bonds, debt of municipalities, and the tax advantage and tax-free opportunity you get from those, which are pretty unique, paying at about 5.8%. You throw in riskier sides of that area because that's still a pretty conservative area compared to corporate debt. Look at that, 7.1 or 8.9 in a tax equivalent standpoint, meaning what would the rate of income need to be, or that yield need to be, or that income need to be if it was taxable, or the equivalent of it being taxable. Look at that, 8.9%. So there could be opportunities there in your taxable portfolios for munis. Jeremy, I was a bit long-winded, but if you can, let's open it up to some questions and answers.
Sure. Thanks, Graham. Yes, folks, it's time for some Q&A. We did have some questions come in. So if you did have a question, you can go to the Q&A section in your chat box there. It says Q&A there. You can type in a question and maybe we can get to it before the end of the call. But we had a couple here. The first one, Graham, was can the equity markets continue to go up with the valuations being so high?
The answer is yes. What is misunderstood is that just because we're trading at high valuations in the market or a certain sector of stocks, that they got to come down in value. And that's simply incorrect. It doesn't have to. It might lead to more volatility, right? Because they're stretched a little bit more, and different events or lack of meeting expectations is going to be cause a bigger effect since they're already stretched a little bit. But as long as earnings are there, you can justify these higher prices. That's why I keep going back to earnings. All the stuff we're talking about sounds really, really good as long as earnings are there. If earnings aren't there, we're going to have a little bit different conversation, quite a bit more volatility. But yeah, I think as long as earnings are there, you can have higher pricing. Earnings aren't there. I think that's the concern.
Gotcha. Second question here. We said, what role should bonds play in a portfolio?
Yeah, and I know it's a struggle, right? You know, if you're looking at your portfolio and you're kind of like, man, I'm not making that much on these bonds, but I'm killing it on the stocks. Think about why you're doing it, right? Think about what role they play. And that's we kind of encourage everyone that we work with our wealth management clients is let's define what we're owning and why, and put it in its correct compartment. Because if you're looking for these bonds over an extended amount of time to beat stock returns or the S&P, you're going to be disappointed. But any one period that could outperform. So think about it. What role do they play? What ballast, right? Could they be a ballast? Could they lower risk and volatility in the portfolio? The answer is yeah, right? Could they maybe provide a tax efficient or an income stream in the portfolio that's higher than maybe what you could get through an index or an individual stock? And the answer is yeah, it could. So you got to figure out what role it plays, right, in the portfolio for your short, intermediate, and long-term buckets for your needs pre and post-retirement.
Got it. I think we can get to one more, Graham. So what do you think the effect of AI that everybody's talking about will have on the markets and the economy in general?
Well, we're still looking to uncover and discover that, but let's just assume it works out like everyone's talking about, because we haven't really seen it hit the bottom line. We just see a lot of these companies spending a lot of money on it, on these chips and the anticipation. but we haven't fully seen. Now we're talking about generative AI. AI has been around for an extremely long amount of time, but we're talking about that generative AI, right? So it's going back to productivity. If we can be more productive, say per employee per that position, right? We can get more out of them, right? That means we don't have to hire as many. That means we can lower our cost and we have more profit hitting our bottom line from the corporate balance sheet. And what happens there? Stock prices go up. So the more productive we can get, more profits, higher prices. Doesn't happen overnight, as we've seen, but sometimes the market likes to price it in. And I think that's a little bit of what's going on right now.
Got it. Well, Graham, I think that's all the questions I had. And thank you to everyone that attended the webinar today. We will be having these at the end of the quarter on the last Wednesday of the quarter for the rest of the year. So we'll be having different topics on through wealth management, through taxes and estate planning and investment planning and all the different things. So we'll be sending that out to you. Check out our website, check out our social media pages for anything. And we look forward to seeing you next time.
Take care.